Me and my friend Barry Burns here with Top Dog Trading. Today we're going to talk about not only futures trading and futures trading strategies. I'm going to give you an example here that can apply to the Dow, the S&P, the NASDAQ, stocks, but also Forex, commodities, really anything you can chart. And this is one of the indicators that I find that a lot of people use. It's one of the most used indicators and the most common way to use it, and it is absolutely horrible. All right, so basically what we got here is multiple time frames. So we are looking at a 5-minute chart over here and a 60-minute chart over here. So that's problem number one. Problem number one is that the ratio of those two time intervals is way too far apart in order to use the longer term time frame as a confirmation for the shorter term time frame. So a 5-minute to a 60-minute, that's a 1 to 12 ratio. In other words, there's going to be one bar over here on the long-term chart. For every 12 bars, I'm not even going to bother to count them, but for every 12 bars over here. So the first thing that means is what's happening over here on the short term or on the longer term chart is so much slower. And yet a lot of people teach that you should use a long-term chart as a confirmation to kind of hold veto power, if you will, over the shorter term time frame. And they'll say things like, well, the long-term chart is more prevalent, it has more domination in the market, its energy is more dominant, it's more accurate, it's more reliable. None of that is actually true. But, and in fact, there's absolutely no logical reason for saying any of those things. They kind of seem to make sense intuitively, so everybody buys into it, but there's no logical reason to that at all. So therefore, that's the first thing you got to get out of your mind. The second thing you got to get out of your mind is, even though I do like using multiple time frames for the alignment of money flow, and that's really what we're doing at Top Dog Trading, is we're looking for the alignment of money flow so that everything, all the various uncorrelated energies of money flow are in sync. They're all going in the same way, as just like you're jumping into a stream with a strong current, and that current is just unidirectional, and we go with the smart money. That's what the whole philosophy of Top Dog Trading is. So using multiple time frames is fine. What's not fine is to use a longer time frame that is so much slower. So therefore, that negates the power of the long-term chart. It's just way, way, way too long of a period of time for it to confirm a trade on the short-term chart. So I like a ratio of 1 to 3. So if I was trading a 5-minute chart, I'd use a 15-minute chart on the long term, not a 60-minute chart. And by the way, these particular time intervals don't hold any particular meaning. I actually personally rarely trade a 5-minute chart. In fact, I never trade a 5-minute chart. That's a popular chart time frame, so I put it up here. It's the issue. And by the way, again, even though these are the E-minis, that is not the issue either. Don't get caught up on this. This works on Forex, futures, stocks, whatever. But we're giving the example on futures today. So so if you're going to use a 2-minute chart, I'd confirm with a 6-minute chart. If you were using a 60-minute chart, say in Forex, then I would use a 180-minute chart for the confirmation. So 1 to 3 ratio I find is very ideal. Now the second problem is that they teach you then to use the indication of trend on the longer term time frame. So if I bring up my global crosshairs here, we can see, whoops, there we go. See, it moves so fast because these time intervals are so far apart. So you can see how many bars I have to move. If you can see my global crosshairs there, hopefully. All right, so there's one bar. Let's see, so 1, 2, 3. Notice how the global crosshairs on the 60-minute chart isn't moving yet. 4, 5, 6, 7, 8, 9, 10, 11. There we go. So that's 12. And so all that movement in here, this entire downswing, really nothing's happening over there on the 60-minute chart. So we've got to retrace on the 5-minute, but just really kind of a neutral pattern on the 60-minute. Now that's just the price bars. The other problem is then they will often teach you to trade in the direction of trend of the longer time frame. So this is the 50-period simple moving average. That's a common trend indicator. And the problem with using any type of trend indicator whatsoever, whether you use the 50 MA or anything else, is that trend is not just direction. In other words, that from there to there is not a trend. From there to there is not a trend. The trend is, by definition, the extended general direction of something. That is literally Webster's dictionary definition. The extended general direction. So it's a long-term move by definition. And we're not just being a stickler with the English language here. That's also important from a trading point of view, in that when we're trend trading, we are looking to trade in the long-term direction so that we get a big reward. We want a small risk and a big reward, and that's why people trade trends, is because they have big rewards, because they are long-term moves. And that's all great, except for one problem. If you're going to use trend on the longer-term chart to confirm the trade on the short-term chart, see, you never get a good setup over here. Now, sometimes you will, but here you certainly don't. This is moving up all day long, and that same day, the 50 MA is moving down all day long. And that's because it is a lagging indicator. And again, by definition, all trend indicators must be lagging indicators. I don't care what type of indicator you're using for trend, if it's this one or another one. And again, that's because the definition is extended general direction. Well, you can't measure the extended general direction of something until it's moved quite a bit already to confirm that you have an extended move. Therefore, it's lagging. Always, always, always lagging. And so here comes the real fiasco, is when you use an already lagging indicator on a much slower time frame, such as the 60-minute chart. It is just going to have zero correlation. Zero. It's not going to help you out at all. Not going to help you, not going to hurt you. It just is meaningless. And in that sense, it actually ends up hurting you, because it can keep you out of otherwise good trades, such as here, where all you had to do is buy at the open and get out at the close. It would keep you out of the whole day. That's number one. So it can hurt you in that way. Number two, it can be information overwhelm. It's just one more piece of information that you've got to consider, and it's completely useless. So why use it? And that's, and psychologically, it hurts your trading. Now, I can understand some people might say, well, that's the 50 MA. What about another trend indicator? So sure, fine. Let's bring up another one real quick here, just to finish things off. We'll bring up the ADX, and that's a very, very, very common trend indicator. So again, let me get my charts lined up here again. And I gotta bring it over there. So there we go. Now, if you can see the crosshairs, so the ADX, now it's going down, and that really doesn't necessarily mean we're in a downtrend just because the ADX is going down. It just means it's resetting, right? So whether the trend is up or down, we want to see the ADX going up. And that's one of the reasons actually I don't like the ADX indicator. So it would not confirm this trade all day long. But the other reason I don't like the ADX indicator is because it has to reset all the time. Go back down to below the threshold line, whatever you set that at, 15, 20, 25, and then wait for it to come back up. I don't like to wait for that resetting. But again, whatever trend indication you're using here, on the long-term chart, you don't want to use a trend indicator to confirm. That's point number one. And number two, you don't want to use a ratio more than 1 to 3 between the short term and the long term. I recommend, well, what I actually do is I do use multiple time frames, 1 to 3 ratio, as I said, but I use a faster indicator than trend. So I use a potential leading indicator, momentum. And I've done many videos on momentum, where our time is up here. Try to keep these videos to about 10 minutes. So check out some of my other YouTube videos on momentum. I've got videos on the RSI, that's a momentum indicator, and so forth, and CCI, and those are much better for confirming on the longer term time frame. So if you like this video, please pay it forward by clicking on the share button. That's really the best thing you can do. Also, if you're watching on YouTube, please subscribe, and you get notified every time I release a new trading tutorial. And click the thumbs up icon, leave a comment. That really encourages me to create more free tutorials for you. And I do have a special offer for my YouTube friends, meaning you. I'm giving you one of my favorite trade strategies called the rubber band trade. It has a very high win-loss ratio. It's a simple trade. I'll teach it to you in about 26 short minutes. So get my rubber band trade strategy absolutely free by clicking on the image in the top right corner of this video or in the description below the video. And if you're not watching on YouTube, there's probably a link below or in the opt-in form on the side. Once you do that, I'll personally email the video to you with the rubber band trade strategy.